In this video, we're going to do a rather simple demonstration of how you can use this worksheet to solve some basic bond valuation issues. As you'll see, there are lots of different things we can ask and things that we can analyze, but we're going to keep this as simple as we possibly can. So let's think about a bond. It's just a loan, right? So the value of the loan is always $1,000 unless you're told differently. The only real exceptions to this are things like United States savings bonds, which really aren't the kinds of bonds that we're talking about. So these are corporate and government, more long-term types of bonds. So the coupon is the interest is paid. So let's say we want to pay, or the interest we're going to have to pay is 5% a year is the interest we pay. Now, the required rate of return is that rate of return that investors want or desire. How do we know what this number is? Well, let's say that this is what we refer to as a AAA rated bond. It's the highest quality corporate bond. If we go to some websites, we can go and we can find the average yield for a AAA rated bond. So let's say a AAA rated bond currently is paying about 4.5%. So all AAA rated bonds are basically paying that amount. Now this is a 30-year loan. We're going to assume compounding frequency once per year. It's either going to be one time per year or two times per year. We'll just do one because, quite frankly, to understand what's going on, we don't need to be that specific with the values here. Now, what you'll see is now we know what the value is. The value is what you'd be willing to pay to buy this bond. So you would be willing to pay $1,081.44. Now, that's the most you'd be willing to pay. So let's say that this bond is currently selling for $1,150. Would you buy something? Would you pay $1,150 for something you thought was only worth $1,081? Hopefully, you know the answer to that is no. You wouldn't want to buy this particular bond. However, if you did buy this bond for $1,150, the yield to maturity is the return you would get on your invested dollars. And in this case, it'd be 4.12%. Over here, we said that AAA rated bonds are currently paying 4.5%. So if you bought this bond, you would earn a return lower than the average everyday AAA rated bonds. So again, maybe this looks like it's a bad investment. Now we can do lots of things with this, right? We can say, well, what happens if interest rates in the economy go up? What happens to the value if interest rates in the economy go up? Let's say interest rates go to 6%. What's going to happen to the value? The value goes down. 862, it goes down, right? What happens, let me go back to where I was, right? What happens over time? In 25 years, what is going to be, if everything else stays the same, what's the value of the bond? It's 1081 now. Now it's 1074. What we find is that as bonds mature, if everything stays the same except for time, the value, whatever it is, will move closer to $1,000. Now, another concept that we can talk about is called the call feature. From time to time, corporations, just like you and I, would like to refinance their debt if they can figure out a way to pay less interest, right? If interest rates fall far enough, they want to refinance at that lower rate to save some money. So let's say, in this case, that the yield to premium is what you'll get paid if they call the debt. So typically it is the par value plus 1 year's interest. So that would be $1,000.50. $1,050 is the yield premium. Now you'll be told what this is. It will never be less than $1,000, right? But it could be more than 1,000 or it could be 1,000. The other thing we need to know is, when can the company call this debt back? When can they force you to sell it back to them? Well, it's written in the bond indenture, in the contract. So let's say 10 years from now, let me go back here to my 30. 10 years from now, the company can call if they want to at this 1050. So what does that tell us? Well, if you look at the yield to call, if they actually call in 10 years, this bond would be worth, or would pay a yield over those 10 years of 3.61. That's obviously, it's what? Less than what we currently, if they held it for 30 years. So again, we have to hope that interest rates don't fall any further and entice the company to call back this debt. The current yield is just a calculation of the coupon, $50, divided by the price. So in this case, the current yield is 4.35%. It doesn't really mean all that much, since most people buy bonds for the long term and not the short term. Now, there is also one other thing we could talk about. It's something called the realized yield to maturity. So the realized yield to maturity says, look, what if we bought this bond today for 30 years? We really don't want to hold it for 30. We only want to hold it for 20. So what do we think the future price will be? Well, we can do that calculation, right? If you estimate or think about what interest rates will be in the future, again, a forecast, you can calculate the price. So let's say in 20 years, we think that the interest rates in the economy are going to fall, so the interest rate's only going to be 3%. So that future price 20 years from now, we expect to be $1,297. And that's 20 years from now. So now what is the realized yield to maturity if we plan on selling this in 20 years? The realized yield is 4.74%. So again, we could buy it at $11.50, but that's a bad investment now. We could buy it at $11.50. That's a bad thing. If they call in 10 years, that's bad. But if they call, or if we keep it for 20 years, we actually would earn about a 4.74% rate of return, which is higher than our required return of 3%. And it's kind of a long ways to get around talking about all the returns, but understanding how prices and interest rates all work together helps us understand how corporations and investors could use. Now, what do we know about bonds? We also know that what? As bonds mature, right? This is compared to interest rates. As interest rates go up, what happens to the value of bonds? They obviously what? They go down. So as interest rates go up, bond values go down. There's an interesting picture there. One other type of bond that I kind of want to talk about. So let's talk about a 30-year bond. Let's say it has a 5%, wrong cell, 5% required return. But this is what we refer to as being a zero coupon bond. It's not going to pay any interest for the life of this instrument. What is the value of that bond moving forward for this investment? this bond is worth $231.38. So if you could buy this bond for $200, would you buy it? Would you pay $200 to get something that you thought was worth $231? And of course you would. And if you did, the yield to maturity is now 5.11%. These things down here won't make any sense for us here, so we don't need these numbers, right? So 5.51 is obviously better than 5%. So again, those are the basics of bond valuation. See you next time.